this video in which we are going to be talking about Disney and obviously the change that's happened. Bob Iger is back and Shamek or Chapek is out. Discuss what that means for the stock, what it means for the business. And here in the Money Cog, as you know, we talk about stock ideas, we talk about how to analyze stocks and looking at companies in specific and doing profiles on them. And you can give us a subscribe if you're interested in that things. Give this video a like so we know that we should do more content which is current and up to date. And you can also go on our website, www.moneycog.com, if you want to know more about companies and stocks. So let's begin and let's talk about what's just happened. So over the weekend, we've done a short presentation on this, but basically, Bob Iger is back. Now, Bob Iger, of course, what's happened. So we know this is kind of what we can talk about. What happened? Why does it matter? Why doesn't it? How this change can help the company grow, valuations. So back to the old. So we heard news overnight that the guy on the right, who was CEO now and has been for the last 33 months, Bob Chapek, is out. Now he was the CEO and he was actually succeeded Bob Iger. And Bob Iger picked him as a successor. And what's happened is that although over the summer they extended Chapek's contract, the board decided they wanted to bring back Iger. And we can go through some of the reasons why we think that happened. But I think one of the reasons, obviously, is the stock price performance has been that great, and we'll look at that in a minute. But the interesting thing is that was this a political move? So there was an element of how Bob Iger was the executive chairman, and there was a bit of a ruffle, and apparently he was meddling too much with the business, and he was removed, and now he's made a dramatic comeback and become CEO again. And we know that he wanted to retire 4 times previously, but he didn't. And the planning, succession planning, it was a bit array, and then obviously he picked a successor, and we are back to square one. And I guess the number one thing is, are we, is this going to be a blast from the past? And things come, someone coming back previously who had a good run and then has a bad run, like an old manager of a football club, or got Ronaldo coming back to Manchester United, does it end well? That's what we're going to here to discuss. And what's interesting is that the board have said that he has a 2-year contract. So Bob Iger comes back, 2-year contracts, and he is going to have a mandate of, first of all, finding new ways or strategies to grow the business, and secondly, looking for a successor, obviously, because it's only 2 years, and given his age and given what he wants to do, I don't think he wants to be in the company and running Disney forever. But as we know, Bob Iger is an amazing, successful business person. He has been the person who started Disney Plus. He acquired Pixar, Marvel, some of the great acquisitions of Disney, and created great value. And I think the board probably believes that he could create more future value in the stock. And that's what we're here to discuss, because ultimately we are investors and we want to see, is this good, bad, or ugly for the stock? So just before the markets opened today, we saw the stock price was actually down 41%. So this is before the news was priced into the market, meaning happened over the weekend. The US market hadn't opened yet. And I looked at it in the morning. It was down 1% year to date. So it's done quite poorly. And we're going to explain this and the reasons behind it a bit later in the financials. But we look over a 5-year period, and it hasn't really done much. It's just gone up and then down again. And we'll discuss that now. But actually, since the market's opened, it's gone up dramatically, like 8%. I think it's come down a bit, but the market hasn't closed for the end of the day, so we'll see how it closes. But obviously, the news has been good initially, and I can see why, because he is seen as this great leader coming back and leading the company, a great visionary. He can build sort of the past. He can sort of take the business in the right direction. If we look back at the old CEO, what was the CEO before Chapek, he'd actually been at the company for 26 years, so not a new person coming in. He had been in the business for 26 years. He actually previously was running the park and resorts business. I think that's maybe where the issues were, that his focus was on the parks and resorts, and maybe the future of the business, future growth strategies are not there. They're more into the streaming and sort of the direct to consumer space, and also looking at new IP, etc., which maybe he didn't have the skill sets for, or didn't have the capability of looking at those new strategies and visions. And actually, we'll go into it in a bit more detail. But what actually, one of the important things that drives change or value in a business is management. So management does have an impact on how a business can, the future value of a business, because they're the ones, again, coming up with strategy, and we are judging how well they are proceeding with their strategy. And Bob Iger's got a good track record. And the different measures you can look at, which are things that we look at the moneycog.com. So if you go on our website, we've actually done a note in Disney, which we'll share in a bit. But we look at things about how a company actually makes money. So first of all, one of the most important things in how this creates value is really understanding the business model of Disney. Like, how does it make money? So Bob Iger coming back, what's he going to change? But without really knowing how Disney makes money, we can't really answer that question. So if we go to the last quarter reports, so we look at the financials, you can find this on Walt Disney's website. Going onto their investor relations website, you can find this information. But if we look, so we go right to the top and we see here revenues, we go down, segments. So how the business makes money. So it makes it through two predominant segments: Disney Media, Entertainment Distribution, Disney Park Experience and Products. So the second one is self-explanatory. It's all the resorts, parks, the products, the physical products themselves with the Disney merchandise. And then Media, Entertainment and Distribution. Well, what is that? What does that encompass? If we go down, it breaks it down. It's linear networks, so things are shown on TV, the direct consumer. So this is all about the Disney Plus, ESPN, Hulu, all the ones they have. And then this is the operating income. And I think the big reason the market had, the reason why the stock price fell so much beginning of the year, was because of this. You see, last quarter, at the same time, it only made a loss in its direct to consumer of 630. That's gone up 3 times to 1.4 billion. And direct to consumer means Disney Plus. And the company has been spending a lot of money on actually producing content for the platforms to rival Netflix and increasing subs in that way, but it's not been profitable. They're looking to next year, I think it's next year or the year after, looking to do an advertising line for the service, subscription service, a bit like Netflix, and offering one subscription service with advertising, so at a lower price, but has advertising, which isn't a bad strategy. And just going back to what we were looking at before, we can actually see that the subscription, so Disney, this was Q2 data, so this is a bit old, but Disney had already surpassed Netflix by sort of middle of the year in terms of subscribers. But actually now, if we look at the information from the year end, it's gone from 221 to we'll get to 237, which will be more than the 227 that Netflix is looking at towards the year end. So that number alone gives you an idea of one segment of the business. So we talked about the direct to consumer, and that's something that Bob Iger was a big part of pushing, and he was a big agenda for. So it'll be interesting to see how he comes and creates new strategies, because the market has obviously discounted that and said, well, that's a problem. Spending 30 billion and not being profitable is an issue. But it's one of those things which is kind of race to the bottom, or who has market share in that content space wins. And Disney's got huge amounts of IP, so there's a potential that it could win in terms of some of the new IP through Marvel, or some of the other platform, or the other sort of acquisitions it's made will continue to increase subscriptions or more traffic to their, or not traffic, but more subscribers to their platforms and to the experience. It's a bit of an ecosystem. So it'll be interesting to see how he comes up with new strategies. I think it's too early to tell right now. Oh yeah, he's great, because he hasn't really said anything yet, and it's just been a massive dramatic change. So everything it's just a lot of hype in the market. So that's one thing to sort of be careful of. But if we look at, I want to go back to the notes that we do at sort of the Money Cog. And again, you can go on www.moneycog.com, sorry, www.themoneycog.com, and look at the full notes. But you can see here, we do a lot of analysis and things. And one of the things we look at is competitive advantages. Ultimately, this is important to the long-term value of a business, and it formulates one of our unique scoring systems called the Cog score, which we have in our Money Cog premium service, which you can get access to if you go on the website. that shows the strength of a company and if it's a good stock or not, and it's rated out of 100. And we look at many factors, but here really the competitive advantages, and you can see the ones that are highlighted, are showing that actually Disney has market power. Yep, that makes sense because it can control, because it has a lot of massive IP, it can control the pricing of its products, can control how much people pay for things. Branding, again, strong brand, everyone knows Disney and been around for a long time in the parks. And then it's known for quality, good quality programming, good reputation. Obviously, a leader in that sense, an innovative approach in terms of their way in which they go about producing content, from Pixar all the way to how they look at things in terms of their parks and innovations in their parks. So a fairly strong business, so it's not going away anytime soon. So in that sense, you can say, well, it's got some strong, great pillars that potentially could be strengthened or not strengthened, but ultimately when you're buying a business, you're buying a business is priced on the value of it's the present value of future cash flows. So what we're trying to figure out is, should those cash flows be higher or lower than what the market is kind of pricing in, and that's the skill set. And if we look here, so a great website that we use, that I use personally, is a website called cofin.com. It's free to join. We're not getting sponsored to advertise them, but I think it's a great platform because it gives you a lot of data. It's like Bloomberg, but for free. So we're looking at a metric here on valuation called EV over beta, so enterprise value over EBITDA. EBITDA is a proxy for profit, and you can see it normally gives you a valuation of how companies traded over history. And I always like to look at the history because you can see, based on its own history, how is it trading. So you can see at a period of last year during the pandemic, it just blew up. So that was way overvalued based on its own history. So obviously it has come down, right? Makes sense. And could say here, well, actually here, maybe it is a bit more fair value. So you can start to get an idea of, okay, well, actually, maybe it wasn't Chapek at all. Maybe this change, the stock price movement was really a reflection of market dynamics. The fundamentals of the business haven't really changed. It was just a political move where Bob Iger, and there was a bit of a disagreement on the board and a ruffle that's caused this change. And the question really then is this a great business to own in the long term? And that's where our notes come in, and you've got to take into account what I talked about more earlier on, which is, okay, have a good grip of how the business makes money, then the fundamentals, and then obviously now management change does have an impact, which is one of the factors that we look at. So and again, it's too early to tell because Bob Iger has a great history, but we haven't heard anything about the strategy. So we've got to have an idea of, does his strategy increase that? I mean, ultimately that's the skill, right? Does his strategy increase potentially the value of the business? And the way you could look at that is by looking at, back to our notes, its existing competitive advantages and how that feeds into its existing pillars, or is it going for a new market? And therefore, why would it succeed in that? So the way in which Disney went into Disney Plus, why would it win in that space? So that's something that we'll be interested to see when Bob Iger comes out. So I think we should just be cautious right now and look for what he says and his strategies, and then also the plan for the next 2 years. And it might be one of those things which is a long hold for 10 years, and his strategy as well. We need to be going into the metaverse, which I believe he's had personal investments in, so that might be a push for him. But curious to watch, and I think we should watch this space. But I hope this gives you an example of what you need to be looking at, how the different factors feed into each other, and they have different values. So again, Disney isn't a high-tech growth company where you're going to see massive growth year on year, but it's a strong business with a strong franchise. It's not going away, and strong quality. But again, in a competitive market space of content, it needs to continue to strengthen its IP by producing more content in the franchises it owns, at the same time being able to go into new potential genres, and not necessarily genre, but spending money on content which could potentially create new revenue streams for them in the future. Maybe that's what Bob Iger's doing, but it'll be interesting to see. So let's watch this space and see what Disney comes out with in the future. But again, I'm not sure that this was one that was necessarily driven by bad management as opposed to more politically maneuvered, and maybe just his focus and what he had done in Florida and the whole LGBT stuff, that maybe it was just a political, well, maybe it was a statement to the markets that no, this is not the direction the business wants to go in. So be interesting to see. And if you want to read a bit more about Disney, you can always go on our notes and learn a bit more at themoneycog.com.